When I first started trading Forex, I made every mistakes you can think of. In today's video, I want to share the biggest lessons I wish I knew about trading Forex back when I first started, and if you can avoid some of the mistakes I made, then perhaps you can accelerate your learning and improve your trading results. First, there is no best time frame and no magic indicator. I am repeatedly asked which is the better, MACD or Bollinger Bands, which is more profitable, ADX or RSI, which time frame is the best, 5 minutes or 1 hour. Well, just like everything in life, it all depends on you. If you like to take things slowly and your time each trade maybe you're studied for trading longer time frames, or perhaps you like the excitement, quick, fast placed actions, then you should take a look at the 5 minute chart. The most important aspects of remember is that whatever time frames or indicator you choose to trade, it should naturally fit your personality. The foundation of your trading plan starts with your self-reflections because you will be the only one using it. Trading indicators or time frames that aren't compatible with your profile and personality will drastically lower your chances of success. There is no magic indicator or timeframes that will bring profit right away. You can make money trading using any indicator. The key is to understand where to use it and when to use it. Some traders focus exclusively on price actions and are successful. Some traders focus exclusively on price actions and are successful. This doesn't mean that traders using indicators are wrong. There are many ways to obtain a profit from the market, but at first there are some questions you should ask yourself so that you can better form your trading plan. Second, don't put your stop loss too close to current price. How often did you enter a trade and thought the setup looked great, and then price when starting to your stop loss before going to your take profit without you? This is a common scenario many trades deal with on daily basis. There is unhealthy habits with risk-reward ratio that encourage new traders to have a small stop loss, so their profits on winning traders can be much bigger than the losses on their losing trades. Sure, it makes sense on the surface, but putting your stop too close to the low of the entry candles is a recipe for getting your account chopped to pieces. A third stop relies on your being very good at picking entries, which you are probably not very good at as a new trader. If you rapidly see what your stops get hit pricely before price reverse into your original directions, it's very likely that you place your stop at least that other traders also use. Especially if you trade the obvious price action patterns, it's very easy to spot amateur entries in forex trading, and professionals know so where the stop will be. So start trading with a wide stop loss and a lower position size well away from your entry third. Don't try to scalp forex news when you first begin forex trading. It can be tempting to try trade data release as they come out because of the extreme volatility they can sometimes cause, but unless you are genius at the fundamental analysis, when I would advise against that. From personal experience, I can say that it is not as simple as it might look. I remember when I started trading back in 2005, and every time there's a non-farm prior GDP announcement, I would put in my stop orders 50 seconds before announcements and hope for the best. I wasn't trading, I was actually betting. Now comes the part which trades completely miss when it comes to news trading. The truth about news trading is you don't trade actual news, you trade people's expectations and how the news priced. Once I understand this, I stopped trying to trade the news altogether. First of all, even if you guess the data release the outcome correctly, or you wait until you see the number before you take the positions. The market reactions may be completely opposite to what you expect, as you have no idea what was already priced in. Second of Second of all, you are completing with state of art algorithms and scalping traders who have better information and technology than you, much faster execution time and better spreads. Not to mention the forex broker waiting spreads and making it extremely hard to place a trade during initial spikes. So remember, you don't trade the actual news, you trade people expectations and how the news are perceived. Fourth, don't put pressure on your tax trade. When new trade was money, they immediately tried to reduce their losses by placing future trades. What develops is a victim's cycle when the trader keeps trying to win back their losses by making bigger and bigger trades, not only to regain what they lost, but perhaps to also finally make a profit on the top of their first initial trade. You end up putting pressure on your next trade. You need that trade to be a winner. Things can get even riskier if the trader decides to involve the leverage in this downtrend. When a new trade loses several traders in a row, he panics and opens a new position, usually with larger lots wanted according to him. Will repeat the previous loss and may bring in a profit. Or for example, you have a monthly goal of 10% and you haven't hit it yet. You might force a trade just because your PL needs a little extra push. When such a trade then fails and you find yourself future away from your monthly return, it can also easily lead to a downtrend spiral. The point is you need to treat all your trades the same way, making positions, sneezing decisions based on the hopes or wants in the recipes or disaster. Fifth, you can lose money even if you win the majority of your trades. George Soros said, "It's not whether you're right or wrong that's important, but how much money you make when you are right and how much you lose when you are wrong. Your win rate or win-loss ratio is the supplied indicator. You could be winning $50 after 10 trades and lose $2,000 on one single trade, which would translate into the win rate over 90%, but almost $2,000 overall loss. How could that be considered positive results? Rather, you should consider your wins against your losses and focus on having your equity curve rise slowly but steadily over time. And yes, at first it's more about losing little when you are wrong and about winning big when you are right. Now, this sounds logical, but that doesn't it mean in the practice. It's all about risk management. Risk management is the most important success factors for forex trading, but also the least used. Many traders choose to overlook risk management because of the perceptions that the more risk you take, the more money you make. Well, this is a questionable consideration because it is short-sighted. The truth is, if you do not manage your risk, you will end up losing all your money at some point. The smart way to make money on any market is to accumulate rewards over time while controlling your risk. How to do this? You limit your exposure by trading small lots. Make a small deposit and start from there. Develop chart analysis skill and learn how to trade based on your forex trading plan. If you manage to grow your account over 6 months, then you can start adding more money. Also, limit the number of the trades you place. 1 or 2 trades a day is enough when you are starting. Spend more time analyzing at the beginning and never enter trades you are not sure about, because it will be harder not to become emotional if they don't turn out as you expected. And limit your losses by using stop loss orders. Do it every time you open a position, no exception. 6. Complexity is your enemy as the beginner. When I first started, I really had no idea what I was actually doing. The first systems new traders go through are heavily indicator based because all the factory lines give the impressions that this is the professional way to do. New traders often believe that the more tools they use, the better the trading signals they get will be. When they try to come up with all the indicators-based rules until they are so confused that the decision-making process becomes a real pain. Now, swipe does not mean easy, and it doesn't mean trading without rules. It is quite the opposite. Professional simplicity can only be reached when the target is 100% clear about his trading systems and approach a trader who is clear about his strategy and who has a set of fixed rules for flows a trading routine. Certainly and rules eliminates guesswork, confusion, and it helps you to make better and faster decisions. 7. You will be wrong a lot. Losing a trade or being wrong about the market directions doesn't mean you are inferior in a way. It just means that the market didn't move in your favor this time. Losing is part of it being the forex traders. The more you try to avoid losing traders, the more money you will lose, because you will be assigned too much impulsive to any one trade. As traders, it's important to understand that even if we see we think is perfect trade setup and it turns into the loser, we didn't do anything wrong. We just had a losing trade. It doesn't mean we are bad at trading or that we aren't smart enough to figure it out. It just means that the particular instance of your trading angle was loser. The point is, you don't have to be right all the time to make money trading. For the most traders, this idea of being wrong and still making money is not something they think about very much. Over a series of 20 traders, for example, you are going to have loser, and you shouldn't become emotional about any losing traders if you are followed a plan and maintain your risk tolerance. So remember, you can be wrong more than you are right in the market and still make money if you make proper use of risk reward and you are using the trading strategy in the disciplined manner. If you learned something new and found value, we would like to show your support. Subscribe to our channel and click the bell icon to stay notified when we upload new video. Until next time.